Everywhere I went this weekend, people kept asking me for a war portfolio. How do they get in shape for what they see as the coming war with Iran? For these people, this long-simmering conflict has escalated past the point of no return. They think there's something to worry about, something big. I don't know if they're right, but war is obviously on the table. So in the interest of caution, let me give you my The World is a Dangerous Place portfolio, which reflects imminent conflict, including an attack by Iran on the United States, followed by some sort of retaliation. Maybe Iran closes the Strait of Hormuz. That handles 21 million barrels of oil per day. Maybe they launch a cyber attack. Maybe they use conventional weapons. This portfolio will work under any of those scenarios. First up, if you really believe we're headed for war, you need cash, a lot of cash. Now, you'll probably make next to nothing on your cash here. That's not the point. When I look at the value of treasuries, I like going out 3 years. If you expect the war to be more protracted, going out 3 years covers you. Of course, the opportunity cost is monstrous. 3-year treasury notes only pay less than 1.6%. Interest rates now, when I got to tell you, high quality common stocks versus interest rates now, I like the quality stocks. But that doesn't mean because cash is king in these situations. I mean, wars tend to create buying opportunities, and cash lets you take advantage of them. So this is the most important component of any portfolio in the world is a dangerous place category. Now, for those of you who want to avoid parking your cash in individual treasuries, I see money market funds getting a slightly better return than that. If you think that an actual shooting war with Iran is imminent, I recommend putting, get this, half of your capital into cash, half, regardless of your age group, because that's a true wartime asset allocation. With such a huge cash position, you're going to be ready for anything. Second essential part of a war portfolio, gold. I prefer owning the bullion or the GLD. That's an ETF that tracks the price of the precious metal. But if you're really serious about war worries, bullion is safer than anything that trades on an exchange. And if you're really extremely paranoid, you know what you got to do? You got to hold it outside the United States. Open a deposit box in a foreign country and put it there. Extreme, I know, but world is a dangerous place. I see gold running from the 1560s to $2,000 in the event of an all-out war. But if owning gold directly feels too conservative for you, I got a couple of stock-based alternatives, a value play and a growth play. On the value side, there's Barrick Gold, which is currently down more than $2 from its highs. Barrick acquired the old Rand Gold, and the combined company is now run by Mark Bristow, Rand Gold's old CEO. I like Barrick because it's got tremendous assets, but the combined entity has only just begun to gel. Excellent cash flow, recently raised dividend. They're committed to producing strong returns for their shareholders, which is a little bit different from the old days. Mark Bristow's one of the best in the business, and he runs a very tight ship. Under his leadership, Barrick's divested some sacred cow mines, not profitable enough. And thanks to those moves, the company now has a stunningly clean balance sheet. All right, so maybe you want more of a growth gold miner. Well, the best of them is Agnico Eagle. That's run by Sean Boyd. Now, just like Bristow, he swears by this new gold model, making money for shareholders and returning it to them via dividends. Unlike Barrick, Agnico Eagle operates in a relatively safe location series, Canada, Finland, northern Mexico. The company's been able to make a fortune with gold at lower prices. I can't wait to see how much they make now that they're higher. Oh, and the stock's currently off 4 points from its high, so I think it's completely legitimate to buy Agnico Eagle right here. Third component of a war portfolio, utilities. You want safety? Go with American Electric Power, the largest power transmission play in America, 3% yield. Con Ed's an asset-light play. It doesn't produce electricity, just passes it on to customers, 3.4% yield. You've also got my blessing to buy Dominion, 4.5% yield. About a year ago, these guys acquired SCANA, Southern Utility, with lots of synergies. That's why that yield's so high, though. I speak with these CEOs of these three utilities regularly. I like what I hear. Fourth, if Iran does, let's say it closes the Strait of Hormuz, that's going to produce a big spike in oil prices, although it might be short-lived because American producers, well, they'll eventually make up the difference, believe me. That U.S. capacity is the reason why the oil futures for the out year, so to speak, are down around 52, which is lower than the current $63 spot price. What's worth owning in the oil patch? Well, okay, here we go. First, there's the best oil service company, and that's Schlumberger, SLB. They should have a lot of business with crude at higher prices because that should spur lots of new drilling in places that haven't replenished their fields in ages. That's typical country investment. Stock sports nearly 5% yield. CEOs committed to the dividend. Second, for a growth oil, how about Pioneer Natural? Run by the great Scott Sheffield, who's been a huge exploiter of the Permian Basin in Texas. Small uptick in crude makes oil from the Permian incredibly profitable. Plus, Pioneer's potential takeover target. Third, you want income? Okay, that's BP. Solid dividend, 6.2% yield. Value. Conoco, which reported a much better than expected quarter and recently boosted its dividend by 38%. You might be busting to buy any or all there. Only if, of course, you believe that we're the world's dangerous place. The fifth component of a good war portfolio, obviously you need a defense contractor. Now, personally, I like L3 Harris. That's a combination of the old L3 and Harris, run by the excellent Bill Brown. This company has an integrated mission systems business that's all about intelligence, surveillance, and reconnaissance. It's also got a space and airborne division where they handle cyber, avionics, electronic warfare, precision engagement sensors, drones, and lots of aviation training. In short, L3 Harris makes exactly what our military needs to wage war in the Middle East. That's the one to buy, guys. That one. At $211, you know what? The stock is only down about $6 from its high. But all these defense contractors have run a great deal. Not this one. If you believe we're headed for war, it is absolutely worth owning here. And in terms of the portfolio, it's probably the one that I would buy with or without a dangerous place going. That said, I can recommend Raytheon in good conscience. It's merging with United Technologies, which is then breaking itself up into three corporations. Once it's acquired, Raytheon will no longer be a pure play on defense. Plus, I think it's rallied too much. Same goes for Lockheed Martin, Northrop Grumman, and General Dynamics. Remember, Raytheon is going to split off with United Technologies defense part, but that's going to take a long time. Finally, let's not forget cybersecurity. For that, we have CrowdStrike, which just came on the show last week and told us that it knows how to stop attacks from Iran. Unfortunately, the stock caught fire today, so you might want to wait for a pullback. Man, it was just strong. The bottom line, if we really get the conflagration that so many people seem to be expecting that I talk to, you have to be ready for the market to take a beating, at least in the short term. My portfolio for the world is a dangerous place, though. It should actually make you money. So if you think a genuine war with Iran is inevitable, you want cash, you want gold, utilities, oil, defense, and cybersecurity. And I bet that even in a time of turmoil related to war, this portfolio will work for you. Let's go to RD in Kentucky. RD.
Booyah, baby. Hey, Cramer, I'm looking at silver as a precious metal. I've always liked it. I wonder how much of it should I invest in my portfolio?
Well, I'm not a silver guy because there's industrial uses. I'm a gold guy. I've been a gold guy since the show started. I like the GLD. I like a couple of gold stocks. I cannot, in good conscience, recommend silver. It's never been what I'm into. Let's go to Robert in Oregon. Robert.
Yes. Good afternoon.
Good afternoon, Robert.
Great. My question today is, my siblings and I inherited some stock this year in Aerojet Rocketdyne when our parents passed away, and I'm looking to maybe purchase some more of this. It's been a steady performer over the past 3 years, and now with the formation of the new Space Force and NASA's exploration aspects and our current political climate, I'm kind of wondering what you think of this stock.
I'll tell you, Robert, I've been genuinely surprised that it hasn't taken off more. It's a really good company, as you mentioned. It does not have the support, enough analysts writing on it. I think getting in ahead of that is a very good idea. You've got a winner there. Let's go to John in New Jersey, please. John.
Booyah, Jim. I'd be remiss if I don't say my condolences for the Eagles, but if it makes you feel better, I'm a Jets fan.
Well, I just hope Carson Wentz feels better. That's all I care about. What's up?
Yes, definitely. He's a tough guy. Okay, my stock is Nucor. I own what I can. I have about $2,500 in it. I bought in July at 56 and then again in August at 50. I want to know your feelings going forward. We have earnings coming. I know the macro picture affects it, both trade war, possible, with the election, so forth like that. I want to know your feelings on Nucor. Is it an own or a trade, or what is it?
It is definitely not a trade. It is an own. I don't believe in buy and hold. I believe in buy and homework. If you do the homework on Nucor, you'll see that they've never had a tough time when all the other steel makers have. But that's why it is the blue chip of the industrial steel makers. 3% yield, safe yield. That's the one. Keep buying it. Keep owning it. If you think you need a defensive playbook, well, you have to be ready for the market to get hit in the short term. But these are your go-to asset elements, okay? And again, I say that this portfolio could actually make you money. We're not profiteers, but that could make you money. Much more mad money ahead. Axon is up over 180% over the past 3 years. But could its drop today be a red flag or a buying opportunity? I've got the CEO. Then a retail call that could surprise you. I'll reveal it and tell you what it can mean for your wallet. And all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.